If you want to become a profitable online trader, whether it be cryptocurrency, stocks, or precious metals, then you're going to want to understand the patterns that form on the trading charts, the patterns that most reliably clue us into where the market might move next. It's important to know for this discussion the difference between fundamental analysis, or FA, and technical analysis, or TA. Looking at chart patterns and the math on the charts is technical analysis, whereas fundamental analysis is more like looking at the news to understand where the price might go next. There are traders who only use fundamental analysis, and there are traders who only use technical analysis. Imagine the most popular option is the combination of the two, but whatever works for you. Today, for this video, we're going to be talking about technical analysis and the top 10 most reliable trading patterns, chart patterns that form and are looked for by traders. The first pattern we're going to talk about today is the symmetrical triangle, which is what is referred to as a continuation pattern, which simply means it's going to continue doing whatever the price is going to continue doing whatever it was doing prior to the formation of the pattern. The symmetrical triangle is characterized by its higher lows and lower highs. According to tradingcenter.org, if the pattern forms and the price was going up before, then there's a 75% chance that it will continue to go up after the pattern has completed. And if it was going down before the formation of the pattern, then there's a 63% chance that it will continue to do so. Now, obviously, there's never going to be a chart pattern that gives us a 100% success rate. You see that pattern that it's for sure going to do X, Y, or Z. That doesn't exist. But understanding the chart patterns and the probabilities that go along with them can give us the edge that we need to become profitable in our trades. The next pattern is called a descending triangle. It's similar to the symmetrical triangle in that it has lower highs as well, but different in that the lows are hitting a consistent level. It is what is called a bearish continuation pattern. And if you haven't heard that term before, bearish simply means that the price is trending downward. So in all likelihood, when this pattern forms, it is in a downtrend, and means that it will continue down. Bullish is the opposite term of bearish. It means that the price is trending upward. Or if you have some news that means the price is going to move up, then it's bullish news. And according to tradingcenter.org, whenever the descending triangle forms, there's an 87% chance that the price will continue moving downward. So whenever this pattern forms, a lot of times traders will enter into short positions. And if you've never heard of that term, a short position, it simply means, well, simply put, it's a bet. It's a bet that the price will drop. So if you're on an exchange trading crypto or whatever it may be, and you think the price is going to go down, you put in a short position, and then if it does go down, you have made some money. Contrary to the long position, which is the opposite, if you think that the price is going to go up, then you can enter into a long position, and then if it does go up, you make some money. So a lot of people have that tendency to think that trading crypto is you buy the asset, and then the price goes up, and then you sell it at a profit, and that's it. But actually, you can make money when the price moves in either direction. The next pattern is the bullish version of the last pattern, the ascending triangle. So higher lows and consistent highs. Also has another high success rate of 83%. So if this pattern forms in an upward or bullish trend, then there's an 83% chance that it will continue upward, making it an excellent pattern to enter into a long position. Now that we've covered the types of triangles, let's talk about flags and pennants. They are similar. The pennant is similar to the symmetrical triangle in that it has higher lows and lower highs, but different in that it is preceded by a sharp move up or down. Flags are the same in that they are preceded by a sharp move upward or downward, but different in that the highs and lows bounce between approximately two of the same levels before continuing. And this is another continuation pattern. Whenever you see flags or pennants, that means there's a higher than 50% chance that it is going to continue doing what it was doing. These, while being a more common chart pattern, are less reliable in that they only have a 55% success rate. So entering into a long or a short position based on the bull flag, or well, the flags or the pennants, whether they be bullish or bearish, is typically only done when there are multiple other factors or indicators that the price is going to move in a certain direction. The next pattern we're going to be talking about are wedges. Both rising and falling wedges are examples of reversal patterns. So whenever these patterns form, the trend in price is likely going to turn around. And for this pattern and just trading in general, it's very important to understand the two terms support and resistance. Support is simply a level, a price level where the current price doesn't drop down below very easily. And resistance is the opposite of that. It's a price level where the current price doesn't rise above very easily. Rising wedges happen when the price bounces between two ascending support and resistance levels. And it's a reversal pattern. So when it forms, most of the time, higher than 50% chance of it will reverse. The trend will reverse. So a rising wedge means falling price. Falling wedges are obviously the opposite in that they have descending support and resistance lines that the price bounces between, and being a reversal pattern means that it will likely break through the resistance levels eventually, whereas the rising breaks through the support. The next pattern is the cup and handle pattern, and it is a bullish continuation pattern with a crazy high success rate of 95%. The pattern is formed when the trend line carves out a little cup, followed by a short retracement making the handle. And is obviously a popular long position entry signal. The inverted cup and handle pattern, which is the same as the cup and handle pattern just turned on its head, is also a highly reliable chart pattern with a success rate of 83%, making it another excellent option and a popular entry point for short positions. The next chart pattern is the rounding bottom chart pattern, which is basically a cup without the handle. So this one actually has the highest, according to tradingcenter.org, the highest probability of confirming the trend with a 97% success rate, making it an excellent entry for long positions. The inverse pattern of the rounding bottom or the rounding top is also another reliable chart pattern with only a slightly lower success rate of 87%. Making another excellent signal for short positions. Usually, traders try and enter into a trade on this pattern when the pattern is about halfway formed, right? If it's a rounding bottom, you enter halfway at that rounded bottom to get maximal profits. Up next, we have the double bottom, which means that the price has found a strong level of support, bounced off of it, and will likely reverse upward. This chart pattern has a success rate of around 80%, meaning that 4 out of 5 times that this pattern forms, it's gonna reverse. So that makes it a pretty decent entry point for long positions. The next pattern is the double top, or the inverse of the double bottom. Slightly less reliable, but still good at 73% success rate, making it an excellent entry for short positions. And also there are the triple top and triple bottom chart patterns, which are virtually the same success rates, right? Virtually the same probabilities. It starts weakening though. The more times, as I understand it, the more times the price hits a support level or a resistance level, the weaker the support or resistance level becomes. The last pattern I have for you today is referred to as the head and shoulder pattern. And it's characterized by at first a small rise and then fall in price, which is the left shoulder, then a bigger rise and fall in price, which is the head, and then another smaller rise and fall in price for the right shoulder. It is a reversal pattern, meaning that when the head and shoulders forms, it will likely turn the price around. So this is another pattern with a fairly consistent and high level of success. The head and shoulders pattern having an 81% chance of success or reversal, and the inverse head and shoulders having an even higher success rate of 90%, making both of these patterns very popular entry signals for many traders. If you now have a greater understanding of chart patterns and trading in general, maybe you learned some terms today, please go ahead and like this video and subscribe to my channel. If you want more cryptocurrency trading content like this, then hit that bell button to be notified when I come out with new videos. Alrighty, bye-bye.